Municipal bonds have certainly had a strong start to the year, but they're making headlines. There's elevated volatility, record supply, and some shifting valuations. Is now the time to rethink your muni strategy? We're going to talk about that and a whole lot more right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore here in our New York studios, and coming to us from the West Coast is my friend and colleague from PIMCO, Dave Hammer, who is the lead muni bond portfolio manager there. Dave, always nice to have you join us here, and even virtually in the studio. It's great to see you. Thanks for joining us.
Hey, Anthony. Thanks for having me.
Anytime, Dave. Look, it's been a really interesting time for muni bonds. As I mentioned in the intro, we've had this strong start to the year. Supply is up, strong year-to-date performance, but there has certainly been a lot of volatility going on right now in the markets. How is that potentially impacting muni bonds as you see them right now?
Yeah, volatility's been the name of the game this year so far. The first 2 months were exceptionally strong periods. Massive inflows coming back into the muni market as the Fed lowered rates and the market was pricing in further cuts. January and February were two of the biggest inflow months into the muni market since 2007. But that is sharply reversed here since the Iran war started. In the month of March, interest rates in U.S. Treasuries are up 40, 50 basis points at the front end of the curve. Muni yields, which were actually quite rich versus Treasuries, in February are up as much as 75 basis points. And as we look back, March of 26 was the worst performance month for the asset class since 2022, down about 2.5%. So valuations have adjusted significantly. Last piece is just repricing recession risks on, was proven to be a really big energy shock. It does put the Fed, in our view, in a very difficult position. Inflation has moved up maybe by as much as about a percentage point, but the economy is in a very different spot today than it was in 2022. It likely is to see further slowing in the economy, a softer labor market. What it means to us is that the Fed may still have to lower rates, but it pushes those rate cuts further out into the future. There's a chance they have to do more. And the economic impact means rising recession probabilities. Here at PIMCO, we've upgraded our recession probabilities from about 10 to 15% to 30 to 35%.
Thank you, Dave. I'm glad you pointed that out because we at CIO here at UBS, we haven't raised any kind of recession flags just yet, but we also agree that we expect the Fed will still cut probably twice, but we are pushing it out further in the year, likely, September, December, probably 25 basis points each. But again, uncertainty really is kind of the word of the times that we're in right now with the Iran conflict. But I want to kind of talk more about the valuations with you, because right now CIO is being maybe a little bit cautious on munis, likely because of the strong outperformance that munis have shown. But where do you think, how do you position the asset class right now for forward-looking returns? What are you seeing there?
Yeah, look, historically, starting yields are a pretty good indicator of forward expected returns in the muni market, and they look attractive to us. The IG muni index is back up to about 3.7% tax-free. You'd have to earn a little over 6% in taxable markets. So a really significant pickup for investors in the top marginal tax bracket going into munis over Treasuries, over corporate bonds, which we would say are also riskier. And there's parts of the market that are even more attractive. Bonds in the 20-year part of the curve, because the muni curve is so steep, an investor can earn closer to 4.5%. That's about 7.5% taxable equivalent yields. And in some of the high quality portions of the high yield muni market, yields approach 6%. You'd have to earn about 10% pre-tax to get a 6% after-tax yield. And in our view, that means taking a lot more risk than what you'll find in the muni market. So we think it's an attractive time to allocate. An investor should be taking advantage of this backup in yields. We agree with you that the Fed is likely to act further out in the future, but still act. And we think the direction of high quality interest rates is still lower over the next year or two.
Yeah, thanks, David. And interestingly, you talked about the muni curve being kind of unusually steep right now, but there's some technical weakening. We've talked about this elevated supply. So given that dynamic that we're seeing right now in muni bonds, what dive maybe into some of the drivers and maybe expected issuance trends that are moving forward here, especially given where we've just come from.
Yeah, so we've come from your point, really rich valuations, yields have moved higher, relative value has improved, and we have what's probably a considerable window of weakness over the next 2 months. You mentioned supply. In our view, supply is going to be quite large again. The muni market used to issue 300 to 400 billion a year. It's likely 550 to 650 billion a year now. Part of that's inflation. If you look at any construction cost index, prices are up 35 to 50%. So every new CapEx infrastructure investment deal in the muni market is going to be bigger. State and locals are also broadly in a really healthy position, so they feel good about borrowing. There's a big federal infrastructure bill that was passed a few years ago. That incentivizes state and local governments to take advantage of those federal funds and go out and do new CapEx, do new infrastructure. And then on the curve, in the corporate market, corporate CFOs tend to react pretty quickly to steeper curves. They'll issue a lot more 5-year bonds, a lot less 30-year bonds. It's harder for muni issuers to do that. Many muni issuers are bound by law to issue level debt service out to 30 years. New infrastructure projects, oftentimes, they have to match the profile of the debt to the useful life of the asset. And that can mean a lot of 30, 40, even 50-year bonds. So the curve probably stays steep. That's a good opportunity for investors. Another thing, adding to this window of weakness, the technicals aren't great over the next few months. Muni investors tend to allocate less capital to muni funds when interest rate volatility is higher, which it is. So we think the size of the inflow waves probably slowed down a little bit. And historically, this is a pretty weak time of the year for the muni market. A lot of muni investors pull money out of muni funds to go make their tax payment between April 15th and May 15th. That tends to mean wider spreads, cheaper valuations. But I think that the most important takeaway, it's a really good time to opportunistically invest and look for cheaper valuations, wider spreads, less competition from inflows between now and the end of May.
Right, and you made a really good point. This is sort of a popular time of year for muni bonds. When we're entering this time of year, they usually increase, and especially if interest rates move, which we are expecting them to. But let me ask you, Dave, as we're sort of wrapping up here, if you look at some of the high conviction ideas that you have and you're implementing in your PIMCO portfolios, because right now at UBS CIO, we're looking at high credit quality, tax-exempt income, diversification sort of benefits as we're looking to, give guidance to some of our clients and advisors. What are some of your high conviction ideas right now?
Yeah, so we really like the steep curve. An investor that extends out and buys a 15 to 20-year maturity, sometimes with a shorter call date, can earn about twice the expected return, in our view, as a non-callable AA bond in 7, 8, or 9 years, with a marginal pickup in interest rate sensitivity. So that's one. Number two, I'd say high conviction is timing. We think given the move in rates and the relative cheapening of munis, the next 2 months are a great time to allocate. We really like multifamily housing risk in tax-exempt form. Depending on the risk profile, this can be high-quality mortgage bonds that are tax-free, backed by Fannie or Freddie. It can be pooled securitizations for affordable housing. In the high-yield space, this can be new issues that are issued to finance affordable or workforce housing that have a yield of 6+%, a relatively low LTV, so good protections for investors if the economy slows. But there are areas of caution as well. While we agree credit quality is good overall, the tide's going out. There are a lot of big urban centers that have been less responsible with their balance sheets, and we do see big budget deficits emerging over the next year. And then I'd say last but not least, while we're constructive on the high quality portions of the high yield muni market, the bottom third of the muni market, a lot of deals that were issued in 2016 to 2021, a lot of those for large scale project finance issues. We think default rates are rising. We see a number of relatively high-profile debt restructurings likely over the next year, and the potential for very low recovery. So in the high-yield portion of the market, we think it's important that investors are careful and really avoid the lowest quality portions of that asset class.
Great. What's your duration preference right now, Dave? We've got an intermediate kind of preference right now, 5 to 10 years. And obviously, if investor demand cools a little bit, that could impact more longer-term bonds. What do you think about that?
Yeah, so I'd say in taxable fixed income portfolios, we're modestly overweight duration and really gravitating towards, call it that 5 to 7 year part of the curve. We think 2-year treasuries are attractive as well. We're still closer to neutral in the muni market just because we think tactically valuations will cheapen a bit more. But, we're biased to extend duration over the next, month or two as a lot of muni supply gets digested into a much weaker market. And the starting point for duration is, for yields, is simply a lot higher than it was a month ago.
Dave, thank you very much. It's always good to get your perspective and always great partnering with you and the rest of your colleagues at PIMCO. Thanks for joining us, Dave. Good to see you.
Thanks a lot, Anthony.
Great. We'll see you soon, Dave. Dave Hammer again from PIMCO. And for more information on anything that Dave and I spoke about or anything coming out of our own Chief Investment Office here at UBS, make sure to visit our website at ubs.com/views. Plus, you can follow us on social media. We're on LinkedIn and Facebook. You can check out the dedicated Instagram account for the studio at UBS Trending is how you can follow us. And as always, if you have any questions about your portfolio or anything that Dave and I spoke about today, please continue this conversation with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day, and remember to keep your eyes on what's trending. We'll see you soon, everybody.